Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Thursday, 19th of September 2024. So welcome to today's Daily Dose of Market Insights. Pretty much interesting day, expose FOMC. So before we start sharing the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, good. So before we jump straight into the short-term intraday technical outlook, after yesterday's pretty much intraday volatile movement across the board in terms of the broad-based cross-asset classes, let's have a recap what has taken shape yesterday. Most importantly, I'll discuss more about the FOMC meeting, and as well as how does the prices react after that. All right. So as we know that we start with the FOMC meeting first. All right. So for FOMC meeting, the Fed, which is very important in terms of how does it impact the global markets, because being said that the Fed is the boss of the entire central bank, really the central banker of central banks. All right. So what we could see over here is that yesterday without any much we call it fanfare, the Fed the Fed reduced interest rate as expected. Didn't hike. I mean, it did not hike. I mean, over here, despite the some actually in some social media account, I mean, actually advocating for a stamp pad because the stock market is at the all-time high. But what we could see over here is that, let me expand my screen in terms of the key takeaway from Bloomberg reported over here. So there was only one particular Fed governor actually dissent. She actually called up for only 25 basis point cut. So the Fed, we in market expected 50 basis point cut as being shown on the CME Fed Watch tool, which I shared with you all at the start of this week daily dose. The Fed funds interest rate futures market is advocating for high chance of a 50 basis point cut. But what interesting over here is during the press conference, Jerome Powell actually he sounded less dovish. All right, so he's pretty much confident that the state of the US economy has not slipped into a recession. That's his point of view. All right, and he also did actually kind of hinted during the press conference saying that he did not see half point cut as the Fed new pace. That means, i.e., yes, yesterday the Fed cut 50 basis point, but going forward, this interest rate cut cycle, there's no guarantee that the next one will be 50 basis point. And he also did mention that it's all pretty much dependent on whatever data the Fed has at that point in time before making a decision of doing 25 basis point or 50 basis point. And with that actually created a lot of intraday volatility in the market. So let us start with the US stock market first. So you could see the US stock market over here. Once the Fed starts to cut rates, the market actually shoot up. Then thereafter, once Jerome Powell starts speaking, the intraday sell-off actually took shape over here. That's for the S&P 500, the Nasdaq 100 as well, followed by the Dow Jones Industrial Average. Give me a minute now. I think it's hang right now. Okay, 1 second. Let me go back. Okay, I think it's hang. My screen is hang for a while. Okay, hopefully it's back up again. Okay, so this is the Dow Jones. All right, so same thing. The Dow Jones Industrial Average also spike up at the start when the Fed announced that they will cut 50 basis point. And once Jerome Powell speaks, very volatile, but at the end of the day, it actually ended in the sell-off, right, to take it down to a new fresh session low during the US session. So what we could see over here is that the stock market is still on a very jittery footing over here. So perhaps it's more like a positioning over positioning play. But most importantly, what's interesting over here is that yesterday the Nasdaq 100 and the Dow Jones Industrial Average didn't actually surpass our respective short-term pivotal resistance that we highlighted on Wednesday. All right, keeping that resistance intact. So overall, the S&P is down negative 0.29%, 0.29%. Nasdaq down negative 0.45%, and the Dow Jones Industrial Average down negative 0.25%. The Russell 2000 almost unchanged. So the weakest in terms of percentage is still the Nasdaq 100. Why? Because I think market participants are still pretty much concerned about this particular recessionary risk scenario in the US, because despite the fact that the Jerome Powell still sounded rather confident, but I think market participants now is that perhaps they start to actually look ahead that the US economy might be weaker, because if not, why the Fed engineered a 50 basis point cut yesterday rather than a 25 basis point cut. So if you look at the overall the heat map of the S&P 500, the worst performer is still the highest beta sector or the highest beta industry, which is the technology and the semiconductor, where Nvidia is now negative 1.29%. All right, and the one that is holding the fort was Apple, only Apple, but can't actually manage to actually bring up the entire information technology sector, because almost all of them are in the red, including the second biggest cap stock in the entire S&P 500. Microsoft is down negative 1%, underperforming the general market yesterday. So then overall, what we could see in the movement of the US stock indices over there is still rather lackluster. Overall, a bit of fearfulness about the US recession has already been in a potential recessionary scenario, where the Fed is late in kickstart its interest rate cut cycle. This is how the market pricing appears to be right now. And if you look at the FX market yesterday, is rather a wild swing. Okay, so if you look at the FX market, so let me actually open up the chart of the FX market over here to share with you all. Okay, so this is the 5-day rolling performance. Okay, give it a while, let me load first. Okay, so what we could see, this is the 5-day rolling performance of the FX market, taking into account. Okay, just ignore this. This should be 19th of September, because no, actually it's 21st. Okay, 19th of September. So this is the 5-day rolling performance as we are speaking now. So what we could see over here is that the dollar initially sell off yesterday. Then once Jerome Powell starts speaking, the dollar starts to spike up again. Then thereafter, during today's Asia session, we start to see the dollar selling off as well. All right, selling off again. So then overall, what we see over here is a very, very volatile movement on the FX market. So it's more like seems to us that it's been a very big rangy market. But what's important over here is that if you look at the the intermarket dynamics, where I plot the US, sorry, drag it back again. Okay, finally it's up. Okay, let's shift this to 19th of September. I don't know why it's 21st of September. Okay, make it more clearer to you guys. Okay, so at the bottom right, when you see this blue line over here is the US 2-year Treasury yield minus off the 2-year Treasury sovereign bond yield, equal weighted average by the major developed economies. That means basically it's the 2-year Treasury yield minus off an average weighted 2-year sovereign bond yield of Germany, UK, Japan, Canada, Swiss, Aussie, China sovereign bond yield, but same duration, 2 year. So 2-year US Treasury yield minus 2-year sovereign bond yield against the rest of the world. So if you look at this over here, right, despite that little push up, right, this intraday push up after the Fed is speaking. Let me expand my screen. Notice that what this 2-year yield spread of the US Treasury minus off against the rest of the world is shaping a series of lower high. Okay, still doing lower higher over here. That means what it's indicating over here is that the treasury yield premium is still on a mode of shrinkage against the rest of the world. Okay, so that actually causes during the Asia session, that particular yesterday's ex-post Fed Chair Powell press conference bounce up and now starts to actually see a bit of dollar weakness coming back into the FX market again. So I would say that it's more of a wild ride. It's an intraday swing so far right now between bullishness, bearishness, and now back into the state of bearishness again for the dollar picture, okay, against the rest of the other currency. So later I'll take you through when I cover the short-term intraday technical outlook on the major dollar pair, so that hopefully that you guys get a clearer picture what's going on the FX market from a short-term perspective basis. But overall, what we could see over here is that if the 5-day trend is more like a sideways movement right now, okay, but nevertheless, the dollar bounce is not sustainable at this point in time. Why? Because of the 2-year treasury yield premium continues to string against the rest of the world 2-year 2-year premium. Two-year. Okay, so take away that this blue line here is the US Treasury 2-year minus the 2-year sovereign bond yield against the rest of the world. It's a weighted average. So the 2-year Treasury yield premium continues to string against the rest of the world, as you could see right now on the 5-day trend, shaping a lower high, indicating that whatever bounce that was seen on the US dollar ex-post Fed Chair Powell press conference is not on a sustainable footing. Okay, so this is the graph, the chart I'm trying to express to you guys. All right, so with that over here, let us now take a look at what is the CME Fed Watch do. What are they pricing right now going forward into the next FOMC meeting? So if you look at the CME Fed Watch do, right, so now the next meeting will be on 7th of November, 2 days after the US presidential election. So market is still looking for a 25 basis point cut, not 50 basis point cut. So we know that the target rate now is 4.75% and 5%. So 68% chance market looking for a 25 basis point cut to bring it down to 4.5%. Only a smaller chance of 31% or 32% that the market is expecting 50 basis point, and this doesn't really change at all. If you look at the previous one, we are now at 4.75%. So this 25 basis point cut to bring it down to 4.5%, the odds rather is almost stable. In fact, it increased slightly higher from a day ago to 68% after Jerome Powell also said that 50 basis point cut going forward is not a guaranteed pace of mode of this interest rate cut cycle by the Fed. So if you compare back a week ago, it's 48%. So now it increased to 68%, calling for only a 25 basis point cut. But how about across the calendar as we move ahead down into next year? So what we can do is we look at the aggregate one. Okay, so on the aggregate one over here, so hopefully this is large enough. Okay, let me expand it larger. Okay, so that you guys could see. Okay, so we are here. 25 basis point cut for the next meeting in November, 7 November, but market is still rather aggressive. No change, still pricing in a 50 basis point cut. Why? Because if you look at 4.5, the next one is the one in highlighted in the turquoise blue box or light blue box over here, stating shading 75.5%. That means there's 75% chance that the market is looking for the Fed funds rate to be at 4% dash 4.25% on the 18th of December FOMC meeting. That means that imply a 50 basis point cut. Okay, after taking into account of a 25 basis point cut in yeah, correct. Yes, 25 basis point cut to bring it down to 4.5%. Then thereafter 4%, there's an implied 50 basis point cut. So what market is expecting now is 25 basis point cut in November, 50 basis point cut in December. So net overall, the entire Fed funds rate will be down by 1.25% by the end of 2024. That means that is 4% to 4.25%. Then thereafter, right, market participants starts to pencil in 25 basis point cut each over here. All right, and it will bring all the way down on October next year, because it's 12-month rolling calendar down the going forward. So by the time in October 29, 2025, the Fed funds rate will be at 2.75%. And market expecting it to actually pause, very interestingly, because you see 25 basis point down. Then after that, it will remain at 3% to 3.25% in the 18th of June 25 FOMC meeting next year, July next year as well, and September next year. So going forward, right, this very interesting over here, these 3 consecutive meeting here, the market participants expect the Fed to actually kind of pause over here in these 2 meeting, July and September next year. Okay, after a series of 25 basis point cut to bring it down to 3% on 18th of June. Then thereafter July, 30th of July and 17th of September next year, these 2 meetings, there will be a pause. All right, so that's what market is expecting right now. But I will still say that it's a rather dovish expectation, much more dovish than the Fed. How do I know that? By looking at the Fed fund dot plot projection. So bear in mind, right? So this is down the, of course, it will not show December because it will only show a 12-month rolling basis on a 12-month basis. So the only one we're able to see the December expectation will got to be after the December meeting. Okay, then we'll have that December expectation next year. So it's a 12-month rolling calendar performance based on how the futures contract that is being expired and how they are traded. So the latest one so far is only up to 29th of October. So by 29th of October, the Fed funds futures pricing is expecting to bring down to 2.75%-3%. So if you look at the dot plot, right, what the market is, the Federal Reserve official are penciling. So this is a dot plot. Okay, so the dot plot will only be released every 3 months, not every month in terms of the FOMC meeting. So the next one will be in December, all right, that they release the next dot plot. So this one over here, right, the important market participants, right, will be looking at the federal funds rate projection. This is the median projection, the central line among all the Federal Reserve officials. So previously in June, right, they put it at 5.1%. So now by the end of 2024, it will be at 4.4%. So market is not much more aggressive because market is pricing in by the end of 2024, which is December here. Market is looking at 4%. Okay, much lower than the 4.4% that the Federal Reserve official are penciling in. And also by the end of 2025, the Federal Reserve official only looking at to stop at 3.4%. That means the path of decrease likely will be hot at the ending at 3.4% in 2025. This based on their projection. But what market is expecting is much more dovish, even before December ends, because that's how the Fed funds futures contract is being priced at 29th of October next year. Market is looking at to be below 3% at 2.75%-3%. So much more aggressive dovish pricing than the US Federal Reserve officials is penciling in right now. So what market participants, right, is looking at the pace of the interest rate cut so far right now is still kind of skewing towards a recessionary-like scenario in the US, whereas the US Federal Reserve officials do not think the US has slipped into a recession yet. So there's actually a toggle between expectation right now, between what market is pricing and between what the US Federal Reserve officials they are projecting or they are portraying in their latest dot plot projection. All right, this is something I'll share with you all. And we know that because market tends to be forward looking, and given the fact that this particular much more dovish pricing of interest rate cut going forward into 2025 seems to be implying that the US may have a kind of recessionary like scenario already or about to step into a recessionary environment, that causing the price of the pricing in terms of the relative strength between various US stock factors to be impacted. So with that, let me take you through the fundamentals and intermarket dynamics. So with that, let me actually give me a few seconds because it seems to be that my screen is hanging a while at this juncture. Give me a minute, right? Give me 1 minute. Seems to be that my screen is kind of hanging. Okay, 1 second. Let me adjust my screen for a while. My apologies. It seems to be that there's something that is hanging over here. Okay, 1 second. Okay, my screen, give me a couple of seconds. I try to adjust. My screen seems to be hanging at this juncture. Okay, seems to be a bit strange. Yeah, so hopefully I think it's okay right now. Okay, so now let me take you through the intermarket and fundamental dynamics. Like share with you, this is particular one that I want to share. Where is it? Yes, this is the one. Okay, so this particular thing over here is still looking at this potential bull steepening taking shape right now. That means, i.e., the market is pricing a rather aggressive Fed funds interest rate cut cycle, causing the 2-year spread to be falling at a faster pace versus the 10-year US Treasury yield. So the difference between the 10-year and the 2-year Treasury yield spread will be skewing up towards in positive territory, now at positive 0.083%. And what's interesting over here is that given the kind of recessionary like pricing that is being portrayed on the CME Fed Watch 2, which I shared with you earlier on, we notice that the relative strength of this momentum factor based S&P 500 divided by the S&P, the normal S&P, continues to shape a series of lower high since hitting a fresh all-time high in July this year. So now there's 3 successive, after yesterday's ex-post FOMC meeting, it start to see 3 successive, 2 successive lower high. Okay, 2 successive lower high over here. So we see lower high, lower high, lower high. So right now, what it implies over here is that the momentum factor is actually losing strength in the US market right now. Okay, over here. So what is momentum? So basically, right, this S&P 500 momentum ETF is a slightly different S&P 500 index, where the highest in moment, the index component stock within the S&P 500 that has a highest momentum factor as being defined by, let's say, moving averages sloping upwards. Example, think of it as that those higher weightage on the S&P 500 right now, being in this momentum ETF, is all the mega cap technology stock. Okay, majority of them has a very, very high weightage. Those banking stocks will have a very low weightage. So this is what they do over here to be a momentum factor ETF. But if you look at the value factor ETF over here, depending on the balance sheet approach, fundamental factor approach, those stocks that has a high, lower we call price to earnings ratio that is considered as value. So these guys, this value oriented S&P 500, the members that has a higher value factor, i.e. one of the metrics will be a lower P ratio, will be ranked at the top. So those are like your utilities, your real estate, some of your energy stocks, and as well as some of the banking stocks will be ranked at the top of the S&P 500. So basically what this ETF did over here is that they reweight all the S&P 500 components according to their various factors. So we know that the momentum factor has been leading the fort since about 2 years ago, even exposed pandemic, and all of them are kind of centered in the Nasdaq 100 and the S&P 500, put it away this way. But their momentum factor has started to show signs of weakness, especially after yesterday's dovish pricing on the CME Fed Watch 2. And what's interesting over here is that the value now starts to show signs of outperformance by a very clear display of a higher low right now. Okay, so going forward, right, i.e., that means what we could see right now over here is that the Nasdaq 100 and in some form the S&P 500 may start to underperform against the general US market, that means i.e. against the Dow Jones Industrial Average and potentially also against the Russell 2000 as well. Okay, so this is the fundamental and the intermarket dynamics that I'll share with you all for today after what has taken shape yesterday, ex-post FOMC. Okay, so now with that, now let us now jump straight into the intraday technical outlook on the FX market, starting with the euro dollar. So before that, now let me actually expand my screen so that you guys could actually have a clearer picture on the chart. Okay, so now let us start with the euro dollar. So still recall that euro dollar yesterday we do have a bearish bias, looking at this 1160. Then thereafter the support level to look out for will be 110.90/110.70. So what you could see over here is that the price actually indeed hit this support level and form a bullish reversal candlestick. So this is a three candlestick taking into account of a long bearish candlestick after Jerome Powell is speaking, exposed Jerome Powell's speech. Then thereafter during Asia session, it formed this bullish hammer candlestick followed by a positive long bullish Marabuzu. So if you take into these three candlestick, 1, 2, 3 is a bullish morning star candlestick. And the bullish Marabuzu that we seen just a while ago, 1 hour ago, managed to actually close above the halfway mark of yesterday's Jerome Powell exposed bearish candlestick that was being inflicted on the euro dollar hour chart. So with this positive element, and given that the support level has been made in our yesterday's bearish bias on the euro dollar, with that we will flip into a intraday bullish bias on the euro dollar for today, using slightly below 110.70, which is 110.50. This former minor swing high over here turns into a pullback support. So slightly below 110.70, using 110.50 as my short-term pivotal support level. So this will be my pivotal support level for my intraday bullish bias today on the euro dollar. First near-term resistance level to watch will be yesterday's minor swing high at 111.60, followed by 112 figure level. Only a breakdown below 110.50 will invalidate today's intraday bullish bias to see the extension of this minor corrective pullback to actually expose the next near-term support level at 110 figure level, which is the minor swing low of 10th of September, and as well as confluencing with the rising 50-day moving average as well. So that's for the euro dollar. Moving on, our attention will be the sterling dollar. So the sterling dollar yesterday, we do have a bearish bias, but first support level to look out for is 131.50. It can't break above 131.50 and shape a bounce off over here. Also shaping that bullish reversal morning star candlestick as well, taking into account these three candlestick, 1, 2, 3. And with this bullish morning star candlestick that is being depicted right now in the Asia session, we will flip to a intraday bullish bias on the sterling dollar using yesterday's first support level, turning into a pivotal support level for today, 131.50. We so correspond to the rising 20-day moving average as well. First resistance level to watch out for will be yesterday's hurdle level that can't break above. Then it actually shaped that sell off during Jerome Powell press conference, which is at 132.40/132.65. Above 132.65 may expose the next near-term resistance level at 133.60. So what's 133.60? This level, it will go back to the daily chart. Very clearly, this was the level over here. Okay, 133.60. This is the one level, 133.60. Former support level breaks, now turns into a pullback resistance. This was during the time of 2 years ago, January 2022 and March 2022. Okay, so that's for the sterling dollar. So, but however, if the sterling dollar starts to break down below our short-term pivotal support at 131.50 for today, that means if hourly close below it, then that would invalidate today's intraday bullish bias to see the continuation of that minor corrective decline to expose the next near-term support level at 131 figure. A break below 131 figure sees 130.40/130.10, which is also confluence with the rising 50-day moving average. So that's for the sterling dollar. Now, turning our attention will be the Asia Pacific currency, starting with the Aussie dollar first. So the Aussie dollar yesterday also a bit of a wild swing over here. But what you could see over here is that today's Asia session, it managed to shape two strong bullish Marabuzu candlestick. 1, 2, and where it bounces off right exactly at our first support that we highlighted yesterday. Again, they can't break below our first support at 67.30, and we shape a two bullish reversal candlestick. So with that, we will flip to a intraday bullish bias for today on the Aussie dollar using 67.30 as my short-term pivotal support level. First resistance you got to, or first hurdle that you got to actually break through will be at 67.95. Above it sees yesterday's minor swing high at 68.20. And above 68.20, the next resistance to watch out for will be at 68.50. So what's 68.50? If you go to the daily chart over here, okay, is this medium-term swing high, this very sharp inverted V on 28th of December 2023. Okay, so that's for the Aussie dollar. So on the flip side, on the Aussie dollar, if the Aussie dollar come shape a push up and it starts to do a reintegration back below 67.30, that means a breakdown with an hourly close below 67.30, then that would invalidate today's intraday bullish bias to shape a further push down or a start of a minor corrective pullback on the Aussie dollar to expose the next near-term support zone at 66.90/66.70, with also confluence with the 50-day moving average. So that's for the Aussie dollar. Lastly will be the dollar yen. So dollar yen yesterday, we do have a pivotal resistance level that is slightly higher at 143.60 because of the wild swing that we may expect. And the wild swing indeed take place, hitting the first support level, come break below the first support level, then thereafter it bounce up. And today's Asia session, you see a bit of a bearish reaction of this 143.70 short-term pivotal resistance that we highlighted yesterday, and also conversing with the 20-day moving average, I think as a similar resistance level as well. So what we could see over here is that indeed we do have a bearish Marubozu candlestick, hourly candlestick, but this long black candle after a retest at the 143.70 short-term pivotal resistance. So this short-term pivotal resistance still holds, and indeed there's a bearish reaction of it. This bearish reaction of it shaped a bearish reversal hourly candlestick called bearish Marubozu an hour ago on the dollar yen as we speak right now. So with that, still no change, still using 143.70 as my short-term pivotal support on a pivotal resistance. Pardon me, I repeat again, a bit of tongue twisting. Still using 143.70 as my short-term pivotal resistance on the dollar yen, maintaining that intraday bearish bias. But first support level that it got to break through down on the downside is 141.40. Given very clearly yesterday, it managed to survive above this level, expose FOMC and expose Fed Chair Powell press conference. So only a breakdown below 141.40 on today on the intraday basis may open up further weakness to revisit today's this week intraday low at 139.70. But however, if price action starts to reverse up and break up with an hourly close above 143.70, then today's intraday bearish bias will be invalidated to see the continuation of this mean reversion rebound to expose the next near-term resistance at 145.40 next in the first step. So that's on the intraday basis. So with that, now let us now shift our attention to the major stock indices over here, starting with the Hong Kong 33. So the Hong Kong 33, finally it managed to actually open in today's Asia session. So with that, it actually broke through the short-term pivotal resistance that we highlighted yesterday, and now hitting the next resistance at 1790 level over here. So with that over here, it seems to us that this price action over here at this point in time is rather overbought again. Okay, so the RSI hit the overbought level and also hit the 76.4% Fibo retracement of that previous decline from the high of 30th of August all the way down to 11th of September. So with that, perhaps what I could do over here is that I'll rather turn neutral first right now because of this rather overstretched rally that is seen on the intraday basis right now. Okay, so what I'm going to do now is let me tidy up the levels as we are over here. Okay, so this one will be the lower neutrality range. Okay, because as we are speaking right now, the hourly candle hasn't closed above this 17,930 yet, and given the RSI has really reached a overbought level, and even the more sensitive stochastic oscillator, let me open it, it should be at the extreme overbought level as well. Okay, I think it's hang right now. Okay, hopefully I'm able to show you all the stochastic, but just now to take a look at the stochastic, it's also at the extreme overbought level. Okay, gosh, okay, stochastic. Okay, notice that this stochastic here as well has already hit the extreme overbought level as well. Okay, almost the same as the previous peak since August this month. Okay, coming close to this peak over here. Okay, so this is a kind of an extreme overbought level. So given that the stochastic and the RSI extreme overbought level, there could be a chance that it may just trade into a sideways fashion again given this very strong 2-hour push up. All right, so with that, I will actually flip to a neutrality stance for now at 17,930, 17,730. Okay, this was yesterday's short-term pivotal resistance, now turns into a pullback support level over here. Okay, so only we start to see, if we start to see an hourly close, that means right now the hour haven't closed it, that means at 12 p.m. Singapore time. If at 12 p.m. Singapore time it's above 17,930, then potentially the Hong Kong 33 may revisit the next resistance at 18,160 slash 18,235 level. Okay, so that's the key levels to watch out for on the Hong Kong 33 right now as we are speaking. So with that, now let us now flip to the Japan 225 or the Nikkei 225. So the Nikkei 225 managed to squeeze up above the Titan short-term pivotal resistance that we have yesterday at 36,780. But what's interesting over here is that it's now at the next resistance level that we highlighted yesterday at 37,570, which also confluence with the 50-day moving average that is acting as a resistance, and right now it's actually current price actually is testing the 20-day moving average, and also the hourly RSI is also back at the extreme overbought level. And if you were to actually put in the stochastic as well, it's also at an extreme overbought level. That's okay, at an extreme overbought level as well. Okay, so over here, let me put it down. Okay, so net overall, right, given that if you were to look at the current price action of the hourly candle of the Japan 225, it start to shape this, okay, doji candlestick. Then after this, we call it a doji candlestick. Then we have this kind of bearish reaction candlestick, but this hourly chart, it hasn't closed yet. So given that there's a bearish reaction over here so far, right now, right at a key significant short-term resistance level at 37,570, and also top of this minor ascending channel that also drew from the low of 6th of September. And given the momentum indicator, both on the RSI and the stochastic is at a kind of an extreme overbought level, there's a risk of a minor pullback taking shape, okay, in the first step. So using 37,570 as my short-term pivotal resistance on the Japan 225, maintain that bearish bias on the intraday basis for today, at least for some form of minor pullback. The first support level to watch out for will be 37,090, followed by 36,780, which was yesterday's short-term pivotal resistance, now turns into a pullback support level. So these two support level to watch. Unless we see a clear breakdown below 36,780, that means an hourly close below it, then that could see a much more deeper slide to revisit 35,150, which is the minor swing low of 18th of September and the lower limit of this minor ascending channel from the low of 6th of September. But however, if price action didn't react down on the downside and starts to push up with an hourly close above 37,570, then we got to respect the bullishness of this intraday price movement. Then that will invalidate today's intraday bearish bias to see the continuation of this recovery scenario taking shape for the Japan 225 to expose the next near-term resistance at 37,880. Above it, potentially kind of revisit 38,620 next. So that's for the Japan 225. Moving on will be the German 30. So the German 30 in today's Asia session, it managed to actually going to churn up and now hitting almost the resistance level, the next resistance level, which is at the current all-time high area at 18,970. So given that the RSI is coming very close to the overbought level, extreme overbought level again. So with that, I would have a neutrality stance for now on the German 30. So neutral between 18,970, which is the current all-time high area, and the 20-day moving average acting as a clear intermediate support level right now, also converging with this minor swing low area of 16th of September at 18th of September at 18,645. So neutral between 18,970 and 18,645. So only if price action have an hourly close above 18,970, then potentially we may start to see higher high for the next resistance level to come in at 19,190, which is the 2 times Fibo extension level over here. So that's for the German 30. Okay, so now moving on will be the major US stock indices. starting with the US Wall Street 30. So the US Wall Street 30 yesterday exposed during the close of the US session, it managed to hit our first support level, then thereafter managed to bounce right now in today's Asia session. So no change, still that 41,810, 41,950 level will be our short-term pivotal resistance level. Still maintain that short-term intraday bearish bias, but price action got to break down fast below 41,535 with an hourly close below it to kind of increase the odds of this bearish bias for a kind of a minor corrective decline scenario unfolding to retest the 20-day moving average that is acting as a support level at 41,105. All right. However, if price action starts to break up with hourly close above 41,950, then this intraday bullish bias will be invalidated on the US Wall Street 30 to start to see fresh new all-time high for the continuation of the impulsive up move to test the next resistance level at 42,335 slash 42,410. And after that, beyond this level, we may see the 2 times Fibo extension coming in at 42,730 will also correspond to the upper limit of this minor ascending channel that I drew from the low of 5th of August. Right, so that's for the US Wall Street 30. So now turning our attention now will be the Nasdaq 100. So the Nasdaq 100 now is actually testing this short-term pivotal resistance that we have at 19,630 level. So right now it equal to have an hourly close above this level. So still waiting for hourly close above this level. So 19,630 will be sure my short-term pivotal resistance right now on the Nasdaq 100. First support level to watch again will be at 19,320, which managed to survive in yesterday's sell-off exposed fat chair pullback. Only a breakdown below 19,320, then we will see further potential kind of weakness or a intraday minor corrective pullback scenario unfolding to expose the next near-term support level at 19,090 level. But however, if you have an hourly close above 19,630, then this intraday bearish bias will be invalidated to see the continuation of this push-up to revisit the minor swing high area of 21st of August and 22nd of August, acting as a next near-term resistance level at 19,900 for today on the Nasdaq 100. All right, so that sum up the intraday technical outlook and the key levels to look out for in across the major stock indices. Now, turning our attention will be the commodities market, starting with gold XAU/USD. So for gold XAU/USD, price action managed to hit the resistance level 2,600, 606 before sliding down and managed to survive right at the short-term pivotal support zone that we highlighted yesterday, 2,553/2,545. And this level, where it bounces off right exactly at the median, not the median, right exactly at the lower boundary of this minor ascending channel support that I drew yesterday as well on 9th of September level. Okay, now September low. So with that, bounce off this level. So this is indeed a short-term pivotal support zone. So the lower limit is 2,545. So still no change, still maintain that short-term intraday bullish bias again on the gold XAU/USD. 2,545 for sure will be the short-term pivotal support level to watch, given after yesterday's intraday sell-off, and it managed to survive right exactly at this level. So as long as this level holds 2,545, no hourly close below this level, still maintain that intraday bullish bias on gold XAU/USD. First resistance level to watch will be at 2,588/595, then thereafter using the next resistance again at 2,600/2,606. Only a breakout above 2,606. Thereafter may see the next resistance coming in at 2,615 on an intraday basis, which is a Fibo extension level as well as the upper limit of this minor ascending channel that I drew from the low of 9th of September. Only an hourly close below 2,545 will invalidate today's intraday bullish bias to extend the minor corrective pullback scenario that has taken shape yesterday to see the next near-term support level at 2,532/2,526, which is rather critical over here. Why? Because it confluences with the rising 20-day moving average and as well as the former range resistance that has taken shape in 20th of August to 11th of September, now turns into a critical pullback support level as well, which is confluencing with the 20-day moving average. So that's for gold XAU/USD. So lastly will be the West Texas crude oil. So West Texas crude oil over here, no change as price action continues to kind of trade sideways below the short-term pivotal resistance that we highlighted yesterday at 72.20/73.15. So still using this as my short-term pivotal resistance, also confluencing with the 20-day moving average, I think as a resistance level as well. First support level to watch will be a zone 68.90/68.05. So still maintaining that intraday bearish bias. But however, if price action starts to break up above 73.15 with an hourly close above 73.15, then today's intraday bearish bias will be invalidated to see the continuation of this mean reversion rebound to expose the next near-term resistance level at 75.07, which confluence with the 50-day moving average, I think as a resistance, and as well as the upper limit of this minor descending channel in place since 18th of July high. Okay, so that's West Texas crude oil, and that's also sum up today's intraday technical outlook across the major cross asset classes. So before we go, let's take a look at the calendar. What are the key economic data to look out for today? So for today, we do have another central bank meeting, which is the Bank of England. All right, over here. So the Bank of England will actually announce its monetary policy decision at 7 p.m. Singapore time, and it also release its minutes as well. So market participant expecting no rate cut this time around, still stand pat at 5%. So if the market, so if it comes within market expectation, and if the minutes start to show a bit of signs of cautiousness in terms of the way the Bank of England officials view inflationary trend in UK, that could actually potential support further firmness in the sterling dollar. Then thereafter, during the US session, not much key important data, not the top tier one, a second tier data, home sales, existing home sales will be releasing at 10 p.m. Singapore time. All right, and tomorrow Asia session, right at the morning at 7:30 a.m. Singapore time, we have Japan inflation rate out at 7:30 a.m. Singapore time, and thereafter we also do have Bank of Japan interest rate decision. So that comes during our daily dose kickstarts tomorrow. That will be at 12 p.m. Singapore time. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off. Have a great day ahead, and we shall speak again tomorrow. Thank you.